Hey guys, welcome back to the Beef Brief. I'm your host, Sarah Cover. And you guys, I was looking at this today and we're in December. So we have been doing the Beef Brief for an entire year. We've done 12 episodes, one a month. And so when we were planning this December episode, what is pertinent? Like, what do our listeners want to hear? What are they thinking about right now in December? And it was a no-brainer. It was like, as December comes, all of us are thinking about tax planning for the end of the year. Like, what do we need to do before December 31st to make sure we are set up for next year? So when I was planning this, I went actually to our CFO at Greater Omaha and I said, who is the best ag accountant in the state that I can bring onto the podcast? And I was so ecstatic that the name that I got is actually who my husband and I use at the ranch to do all of our accounting. So today we have Tyler Hohenstein with Let's On as our guest, and I'm so excited. He has provided so much value to me and my family with the amount of information, and I'm ecstatic for him to be able to bring some information to you guys today too. So Tyler, introduce yourself to our listeners. Give us a little background on you.
Hey, Sarah. Yeah, thanks for the opportunity, and really excited for this. I mean, as it is an important time of year, and so a little bit about myself. I'm originally from South Sioux City, Nebraska, northeast corner of Nebraska. Grew up doing construction. My dad's a contractor, so I grew up swinging a hammer. And then 5 years ago or so, I moved to central Nebraska and met my wife, who's a large animal veterinarian. Then her family also farms and ranches and has a feedlot. So my current life is not only probably 75% of my book in the accounting world is in the ag space, but almost 100% of my rural world is in the beef cattle and farming industry, which I mean is nice to put it full circle where it's something that I get to talk to my clients about it, but I also have firsthand experience and get to
Yeah.
live the ups and downs. And I mean, on the veterinary side, it seems like the last couple months with being in the middle of preg season, the date is going and helping my wife preg cows for Saturday mornings. Get a lot of firsthand
Yes.
experience, which is a lot of fun.
Yeah, we always called that being hired from the neck down on the weekends, right?
Absolutely.
Yeah. Oh, I love it. Okay. Well, we try to keep these short, so I'm going to try to pack as much information in here as possible. So let's just talk through, why is year-end planning important for these ag producers, specifically cattle guys on a year like this?
Yeah, I mean, this is really unprecedented territories as far as the beef world. I mean, it's a backbreaking industry. I mean, everybody puts in a ton of work and getting paid for it is something that I mean everybody's kind of strived for. But I mean, I've had a lot of conversations that these producers that have been doing it their whole life are saying, I mean, I've never had these issues. And I mean, I try to remind people that, it's a good problem to have. It's better
Yeah.
than trying to figure out how you're going to make your next payment. So I mean, there may be some tax implications, but let's do that in the most tax efficient way. And there's a lot of different tools with, the one big beautiful bill that was passed in July and just some different deals that deal just specifically with ag that some levers we can pull to, get through this tax season and future tax seasons the most efficient way.
Yeah. So what do you think the most important tools that these guys need to be aware of before the end of the year?
Yep. So I mean, I think if you're selling cattle at this point in the year, I mean, be having these conversations, and in the last couple of months, I've had a lot of these conversations of, does it make sense to bring that income into this year, or do we want to defer the income into next year? So with the one big beautiful bill, if there was not the one big beautiful bill passed this year, bonus depreciation was going to go to 40%. So if you bought a piece of equipment, you could take 40% of the deduction this year. Now you can take 100% of that on any assets purchased after January 19th. So I mean, that gets into a whole nother conversation of cash flows. I mean, the saying I like to use is don't let the tax tail wag the dog. So, I mean, if you're
Yeah.
looking at buying equipment, don't just go buy equipment to avoid tax. I mean, that's where I think the planning piece is so important. It's like, yeah, we can
Hmm.
get it to where you don't have to pay a bunch of tax, but does that really make sense in your operation?
Absolutely. Yeah.
Because I
Is
mean,
that
at the end of the day, if you're borrowing to purchase this equipment, you still owe on that equipment. You still have to have the cash flow to do it in future years.
Absolutely. So, is that the most common mistake that you see, or are there other things that these guys get kind of hooked on that end up being a long-term detriment?
Well, I would say just in general in the ag world, I mean, it's a deferral game, and
Hmm.
this is the year where it's hard to kind of kick the can down the road. So, I mean, I think bonus depreciation will be used a lot this year. I think just the lack of planning, I mean, it's an industry that's very demanding. And most producers I work with, the last thing they want to do is after a long day of sit down and go through their books. And so, I mean, I think just the planning earlier rather than later gives you a lot bigger runway. And then it gives you a lot more opportunities to think through the cash flow and how you're going to pay for the stuff that you're buying to efficiently pay tax.
For sure. So, I have a couple questions on this topic. On what about prepaid expenses? Like, my family does a lot of that. What are the pros and cons of doing that?
Yeah. I mean, so I would say the prepaid expenses thing is a giant tool to use. I mean, and that's what it's an easy way to pick the number to where you can kind of get your income to where you need it. I mean, the downfall I would say is the longer you do it, the least tax you pay, then you can get to where you have a giant snowball. So you're just chasing that prepay every year,
Yep.
which isn't always the wrong answer, but it can get to a point where you just can't outrun it and you end up paying more tax than if you maybe paid some through the years rather than, paying it until you can't outrun the snowball and then having a giant tax hit.
Yeah, definitely. Another question I had is, let's just say one of our listeners has done nothing to prepare for the end of the year. Where's a good place to start? What should they be doing the next 20 days before the end of the year?
Yeah, I mean, I think, and that's not an uncommon thing at all. So, I mean, if anybody is out there and is in that situation, I mean, don't panic. We got some time, but I would say, I mean, get with your accountant or get through your numbers and kind of figure out where you're at, and get on the phone with your accountant and just kind of run these scenarios. I mean, accountants everywhere can put numbers on a form, but like this time of year, the consulting pieces that you can do, that's what
Mhm.
kind of fills my bucket more than putting numbers on a form and getting your tax return and getting out the door. So, I mean, I think it's beneficial on both sides. I think that's a lot of accountants like doing this kind of stuff. And I mean, that's what is fruitful. You're helping your client get better this year if you kind of get on that same page now and rather than wait until, March and it's too late to make any moves for the previous year.
Yeah. Yeah. At that point, you're too late. So, in that same model of like, hey, we're playing catch up, what is, there's a lot of businesses out there that are just owned under the owner's name. What are the advantage of doing like an LLC or a partnership or an S Corp, from a tax standpoint?
Yep. Yeah, so there's pros and cons to all of them. So I would say the LLC is more of just a legal protection. So it's a disregarded entity from a tax sense. So it still flows through your 1040 like it would be if you just owned it personally, but it is a form of liability protection. So I think that makes a lot of sense, kind of no matter what your structure is to have an LLC. Benefit of the S Corp is basically you have to pay yourself a reasonable wage for somebody in your industry. And the downfall that I see a lot of times in the ag world is a lot of these operations are highly leveraged and there's some basis rules, and I don't want to bore anybody with basis rules. So if you have issues, I mean, talk with your accountant on it. But the benefit is the income over the top of what you're paying yourself in wages is not subject to self-employment tax.
Okay.
So, but the downside is if you say you buy a piece of equipment and you go back to the 100% bonus depreciation like we were talking about, and put $1,000 in and you buy $100,000 piece of equipment, so you borrowed $99,000. If you don't have basis, if you haven't put that much money in, you really can't take that whole deduction for that. So that's where, especially in entities that are growing and have a growth mindset, sometimes that's a mistake I've seen that maybe it gets flipped to an S corp too soon, and then we don't get these losses that we think losses or deductions, I guess, that we think we should.
Okay.
So that's a limiting factor with the S corps.
What do you see? How do the corporations play a role in like wealth transfer or business transfer from generation to generation?
Yep. So the corporations, I mean, it kind of the general rule of thumb of what we try to do most of the time is keep like assets that are going to appreciate, like land outside of corporations. basically, if you're going to take land from your left pocket and put it in your right pocket from a corporation, the appreciation of that asset is taxed, even though there's no money that changed hands. So,
Hmm.
from a wealth transfer perspective, a lot of times if you can keep, the highly appreciating assets out of the corporations, that's good. And I mean, it does cause more headache, and you have some more hoops to jump through. But at the end of the day, the extra compliance costs that you have is new. It's a drop in the bucket compared to, I mean, the land appreciation we've seen in Nebraska and across the country over the last 20 years. I mean, that's not a little number. So it
Yep.
makes sense to, understand your structure and, I mean, understand the goals. And that's the thing that I've kind of like to, have the conversation of. And I mean, we've already had that with you, Sarah, of like, what's your goals? I mean, what's the goal of the next generation? And that doesn't have to be that's what it is. That's just what our best guess is today. So
Right.
most of these things that we can do, I mean, if you change your mind next week, you can change how that stuff is flowing.
So, a couple things here is when you and I were discussing before this podcast, your biggest thing is yes, this we're focusing on year end planning, but when you're talking about taxes and entity setup, it's really like going back to what's your 5, 10, 20 year goals, long term goals, and how do we set this up correct to begin with? So, lay that out for us. Like, how does that conversation look, and what are the things they need to be thinking about?
Yeah, absolutely. And I mean, I think it's a conversation that nobody really wants to have. I mean, because really at the end of the day, you're talking about when you leave this earth. I mean, all on a lot of this estate planning but I think it's a very important deal and that can, set us up for success. And I mean, I guess I'm kind of a dreamer, I would say. So like I have goals and I know my clients have goals and like all right, why don't you tell me about your goals and then we can figure out how to get there. And maybe it costs us a little more in tax this year, but in the grand scheme of things, over a 5-year run, we're saving way more in tax. Or when you're trying to transfer assets to the next generation or maybe a hired hand, or I mean, there's all different avenues you can go down. Then
Yeah, because
we're doing that.
there's so much money in cattle right now. I would imagine most of these businesses are, if they have a younger generation coming, they're looking to grow. You know,
Yep.
buying ground or picking up a big lease or something like that that's a conversation you probably need to be having with your accountant now, right?
Absolutely. I mean, I think that's the best relationships I have with clients is when we kind of talk about the big picture and not just look in a 1 year kind of small
Mhm.
lens. If we can get a 30,000-foot view of, all right, here's where we're at today, here's where we want to go. I mean, let's figure out how to get there, and we can do little things each year to get to we're at the end goal where we want to be. But I think it's a very important conversation to have. And I think I mean, I've used the opportunities in December where I have people talking about year-end tax planning to like refresh on the goals, figure out where we're going, and have we made any changes or kind of what's our next 5 to 10 years, like you alluded to, look like.
Yeah. What's explain what section 179 is and how that's a tool.
Yep. So Section 179 acts similar to bonus depreciation. So bonus depreciation basically says if I have a 5-year asset or a 7-year asset, 15 or 20-year asset, I have to take any assets that I purchased in the last year, I have to take 100% of that deduction. Section 179 acts similar where you can accelerate depreciation, but you don't have to take all of the 5-year assets. So say you bought 2 tractors and you want to take $50,000 of one tractor and then the rest of the depreciation goes over the next 5 years. So
Okay.
Section 179 is where you can pick and choose a little bit more as far as the depreciation number that you need for the current year. And then the remainder of that depreciation goes over the rest of the life of that asset. So
Yeah.
I would say bonus depreciation is more all encompassing where you're taking everything 100% deduction this year, which is, I mean, can be a trap, like I alluded to, especially if you're borrowing on the equipment, because I mean, at the end of the day, you still have to pay for that, but you used up all your deduction this year. So you might have escaped the tax bubble for this year, but next year you might have income tax and you have to make the payments on the equipment or cattle or whatever you're purchasing.
Yeah. No, I think that's a huge tool that guys should be aware of, which if they're working with a accountant, they absolutely are at this point, right? This is
Yep.
something that they're implementing now.
Yeah, and I don't think, I mean, I prefer it when clients ask me about the different options. I mean, don't just take whatever your accountant says for gold. Like, I mean, ask those
Y-
questions because maybe they don't know about what what your plan is for next year. Or if you're going to have a big income event next year or in 2 years, well, then maybe it makes sense to take some of that depreciation over the next, couple of years rather than taking it all this year and
All
just
in one.
avoiding 1 year attacks.
Yeah, absolutely. Okay, so let's look ahead. How do guys plan for next year? Like, what do they need to be thinking about come January?
Yeah, so I mean, there's a lot of things that kind of go into that. I mean, who knows with these cattle prices? I mean, if I knew what cattle prices were going to do the next year, I don't think I'd be an accountant. I'd be doing something else where, where I was making more money. But
Yeah.
so I mean, there's a lot of flexibility in that, or fluctuation that could happen in the next year. There's some different tools out there to kind of lock in prices and secure your profit for the next year. So I have some producers that look at different hedging options or some livestock protection insurance that kind of locks in
Mhm.
some prices for you. So, I mean, that's something to think about, especially with the uncertain times that we have. Also, I mean, I think just kind of a general cash flow, and I like to run scenarios of, okay, if prices do this, then this is our revenue for the next year. And if it does this, then this is our projection. And then we can kind of start pulling the other levers of depreciation and prepaids and
Yeah. When do you think the year-end tax conversation should start? When do you like to have that?
I like to start kind of bugging people. And I mean, so I work with people in row crop and in the cattle business. I mean, in October, I probably start bugging people. I mean,
Okay.
some people are starting to get out of the fields and just more so just start thinking about it. Think about what you want to talk about when we get together.
Mm-hmm.
I mean, it doesn't have to be anything, but let's not wait until December 15th and have the conversation. Let's get ahead of it a little bit. Then it just gives us a longer runway. Because, I mean, these decisions that people are making, it's not like I'm going to the convenience store and buying a can of soda. I mean, it's hundreds and millions of dollars of
Yeah.
money changing hands in the last few months of the year, or potentially can be. So, I mean, it's big decisions to make, and it's not something that I like making at the very end of the year.
Yeah. So you've hit so many topics. Like I have to go back to one. You'd mentioned a change on the depreciation with the big beautiful bill. What other items are we going to see that are going to affect in 26 that we don't have currently that we are concerned about or excited about?
I would say so just in general to kind of back up, I would say the One Big Beautiful Bill or OB3, there's a lot of different acronyms that are getting thrown around about this deal is the the estate exemption. Previously,
Mm.
it was, I mean, I guess for 2025, it's 13.99 per individual that you can pass on to the next generation without any estate tax. And that was set to sunset at the end of 2025 and get cut in half. So it was going to go down to approximately 7 million, which I mean with land prices and price of cattle, that doesn't take
Yeah,
a lot for an estate for some of
for
these
sure.
operators to be north of that number. So with the One Big Beautiful Bill, that got extended and I guess it permanently extended until the next administration potentially, I guess. So it's not permanent, but it's $15 million a year in 2026, or per person in 2026. So a married filing joint couple could pass on $30 million
30.
without estate tax. And that's
Okay.
indexed for inflation. So that number will go up a little bit each year. So, I mean,
Great.
that's a giant move as far as these operations looking at either wealth transfer now or when their estate
Yep.
occurs. That frees up a lot of, because that estate tax is 40% on your assets over that 30 million
Wow.
now or 15
Yes.
million. So it's a big tax bite if you have a taxable estate.
Yeah, that's a
Um,
huge win.
I mean, there's some other things that are more minor. I mean, the no tax on tips and overtime, that in the egg world, since it's a federal law that overtime isn't required in the egg world, it's kind
Right.
of the general consensus that that doesn't qualify. So there's no overtime, basically, so you don't get the benefit of that deal. I
Hmm.
mean, there's some cool things as far as like some of the Trump accounts and just, I mean, the idea of
Yeah,
that is to,
I did read that on kids born between 25 and 28, they'd put $1,000 in.
yep, and then you can
Did you see
contribute
that?
to that as well. Yeah, yeah. So that's, I mean, that's a good way to just show, I mean, kids that over there, because they can pull it out when they're 18, just show the growth and how your money grows. And I mean, whether it's in the stock market or if you're investing in ground or cattle, I mean, the goal is to have your assets appreciate over time
Yeah.
or keep your operation growing. So I think it's just a good starter to get kids to understand that saving some money or investing it in things that appreciate, I mean, can the compounding of that is just a giant tool that we can all use no matter kind of where your assets are. And then you can also contribute into those, like the parents can contribute into those accounts. So
Tax
not giant.
free, right? This is
Yep.
okay. Yeah. I mean, I feel like we could do a whole podcast on that, on the big, beautiful bill items for sure. But we are knocking on the timeline. Why don't you, Tyler, give us one thing that you think is the most important takeaway from today? And then I'll wrap it up after that.
Yeah, no, I think, I mean, use your accountant, I would say, as a consultant and not just somebody who gets your tax return done at the end of the year. I mean, most people in the ag world use a lot of consultants, whether it's agronomist, nutritionist, something like that, and you're on the phone with them multiple times a year. I mean, I would say that's something that is worth doing with your accountant, kind of maybe flipping the mindset of let's use them as a consultant. And if I can make your operation 1% better every year over a 20-year period, I mean, that's going to be a pretty good number. And I would say just don't be afraid to pick up the phone and have those conversations and put your
Yeah.
accountant to work a little bit.
Yeah, and absolutely. What I've learned in the last 22 minutes truly was it's worth being invested in understanding how your operation works from a tax standpoint financially. So get engaged, learn as much as you can because it will pay you back big time. Tyler, this was huge. I so appreciate all the information. You are a wealth of knowledge. I'm going to have to probably have you on next December too, just to see how things have changed and do a catch up. But everybody, welcome. Thank you so much for joining us this first year of the Beef Brief. In January, I'm actually going to have Dustin Schaff on, our head cattle buyer, to really do a let's look back to the last 12 months with the cattle market, which there is plenty to talk about because it has been wild. And then also looking forward to 2026, what we have to look forward to. Appreciate you guys listening and your engagement and look forward to having a fun year next year. Thank you.